Everyone, this is Darius Casti. I'm the CEO at FundSomm.com or FundSommelier. Joined today by TR Hazelrig of Avatar Financial Group. So TR, thanks for joining today.
Thank you.
Yeah, and I'll ask you to introduce yourself here in just a second, but real quick. So at FundSomm, we're curating what we believe to be quality fund managers around the space with different investment opportunities, structures, strategies, so forth and so on. So the quick disclaimer is, all of these types of investments have risks. So please make sure to review the offering materials thoroughly and ask any questions of us or your CPA or financial planners as you see fit. So with that, we encourage people to ask questions. You can throw those in the chat box as we get going here. And this will also be recorded, so people that aren't able to join today will be able to view this in the future. So TR, again, thanks for joining today. You're coming at us from Seattle area, and maybe if you could just give a brief introduction on yourself, your background, Avatar, and then we'll kind of get into your REIT and what you guys have going on.
Sure. I guess the background starts really in 1995. So Jerry Zevenbergen, the co-founder of Avatar and also co-manager of our mortgage REIT, the two of us have been portfolio managers since 1995 together. So especially in this industry, that's pretty unheard of. We've been interviewing recently, and we call them popcorn resumes. In the finance industry, people tend to bump around quite a bit, but we've been a management team together since 95, so been together for an extraordinarily long period of time. Yeah. We co-founded Avatar in 2003 with one of the world's largest endowment funds, so originally managing funds just for their account. Since that time, we've expanded. We have over 100 family offices, high net worth individuals, a handful of life companies, and other institutional investors. So that's the basic makeup of Avatar today. The mortgage REIT funds, as it grows, the maximum loan size will increase, but in general, we're funding loans under 10 million in the REIT and above 10 million with institutional investors.
Perfect. Okay, so maybe with that, if you can just give us a run through. I know we have some slides here, so however you'd like to run the presentation, and just give us some more color and flavor on what Avatar is all about, the type of loans that you're doing, the type of borrowers, maybe the interest rates, some track record stuff, what's in the existing portfolio, and I'll let you run with it. Maybe I'll jump in with some questions here and there, really with the idea of helping what I believe investors want to know, or to ask some clarifying questions. And then again, if anyone has questions along the way, throw those in the chat box. We'll try and get to those as we can. So okay, sure. I'll turn it over to you.
Sure. The REIT is a great investment vehicle for really people that are at a stage in their life where they're moving away from borrowing and would rather be at a stage in their life where they have accumulated wealth and could lend it out at this point. So we are a private lender in today's environment. If anybody's been following kind of what's happened with some of the community bank failures, a lot of the banks have retreated from commercial lending. They're trying to shore up their balance sheets so they're not next. And also Avatar, because as portfolio managers, we've seen so many cycles, we purposely set the REIT up so that we do have a line of credit that allows for efficient cash management, but we are not what most of our competitors are, and that's a levered fund. So in general, if you're looking at other REITs, many of them will only have about 25% equity in their fund and approximately 75% debt. And that was very lucrative over the last decade when money was very cheap. But now that those rates have doubled, many of those lenders have stopped lending. So we're in a unique position where there's tremendous demand for our product, and there is a tightening of supply currently. And that product is first lien lending Typically on commercial property, we do a little bit of investor-owned residential, but it's usually your major food groups of commercial property. So industrial, multifamily, mini warehouse, retail. We did retract from office lending, and currently our portfolios are approximately 3%. So when you hear about the downturn and devastation in commercial real estate, if those are headlines to click. But when you read the article, what you will typically find is where the real problem is in office. It is a disaster attuned to kind of what happened in 08 and 09, but our exposure is limited to 3%. But of the major food groups, as an investor in the REIT, you're very diversified in almost all types of commercial real estate. So if you take a drive today or this weekend and look to your left and your right, those properties you're passing are what makes up our portfolio. Yeah, that'll give you a good. And also it's geographically diverse. Most besides 08, 09, most recessions were somewhat regional. The dot-com bomb, for example, hit Northern California, Southern California chugged along. In general, we say we lend in the smile states. So if you're looking at a map of the US and took a very large marker and went like that and out in Florida, that's where you're going to see most of our portfolio. Typically, we lend maximum that you'll see in the portfolio is 70% LTV. We say typically our maximum 65. We've been averaging low to mid 50% average LTV in the portfolio. So that's kind of a general makeup of what we're lending. LTVs, interest rates are currently approximately 11 to 13%. And the big question most people have is, why is somebody borrowing at 11 to 13%? Really, two major reasons. Currently, timing is our best friend. The banks are extraordinarily slow. If anybody's gone through a home mortgage and realized the just endless amounts of paperwork that you had to provide and how much longer and how much more time it took than you were expecting, it just kind of multiply that in the commercial arena as well. So a lot of borrowers that are bankable are not bankable in a time frame that's meaningful to them. So they have a contract that they have to close. They've gone hard on an earnest money. They've got a 1031 exchange where they've sold a commercial property, and the IRS only gives them so much time to transfer that tax-free. Those are all reasons that a bankable borrower would have to go to private funding to meet their deadlines, and they will then conventionally refinance out of the portfolio. And another portion of those borrowers is common sense would tell you that that's a loan that definitely should be made, but there may be something out of alignment. That can be as simple as multifamily. A lot of new construction took longer than expected, and the construction loans need to be paid off. So we may see a low loan to value, but a conventional lender wants to see 90% occupied for 90 days. If we see a very strong ramp up and you're at 75% and you need a 60% LTV, but we can see that you'll be ramped up based on your past 3 months and the next 3 months, we're there to bridge that. But there's credit scores. We've had borrowers that have 100+ million net worths and great global cash flow. A divorce, for example, if a Verizon card and a Nordstrom's card aren't paid on time, we can look at that and in the real world, we added up some missed payments that were under $1,000, and a borrower had 150,000 of free global cash flow a month. You go, who cares? That we can see through that. If that credit score is in the low 600s because of those small dings, the credit agencies don't look at global cash flow. They're computer generated, so they can't take a step back and see that that's a rounding error and a rounding error. So there are luckily the banks needed to be regulated and put in a box after the disastrous underwriting of the last Great Recession, but that box is not forgiving. So the common sense has been removed, and that allows for us to be able to solve people's problems, bridge them to where that credit score goes up, or that occupancy gets to 90% in an office building, or a myriad of other reasons that a box that needs to be checked isn't now, but can be within a 12 to 24 month period.
Yeah, no, that's a great summary. And I mean, as you're talking through that, the term that just keeps coming to my mind is that you're really an asset-based lender, right? I mean, you're looking at the real estate and you're looking at the borrower globally as well, as you mentioned. But to your point, a lot of times, for one reason or another, that doesn't fit in this really rigid box that more conventional lenders typically have. And so you're either solving a timing issue or an asset that just needs a little bit more runway to get to a point of stabilization, or some other situation to get to more permanent financing with more traditional type lenders.
Yeah, correct.
So,
I'd say there's
yeah.
an arc. There's an arc. There's what's known as hard money lending. True hard money lending just looks at an asset. So if you have a building and somebody wants 50%, you look at that and you don't care about anything else, because in a worst case, you could double your money on that. That's true hard money lending. And then there's the gauntlet that you'll go through at Bank of America or Chase, for example. We fall somewhere below a bank and above a true hard money lender. So we're not only underwriting that 50% LTV, we're underwriting is there the ability to service the debt, and within 24 months, is there a viable exit strategy? So we are looking a little more holistically at the transaction, because we're not looking. There's nothing wrong with the hard money model that can be very profitable. We're looking for a borrower that's actually going to perform and just exit the loan.
Yeah, no, that's a great clarification, because I mean, a lot of people call those hard money lenders loan to own shops, right? Where you're making a loan and your worst case is, or your best case, depending on how you look at it, is that you get the property back. That's not your objective here. You don't want to get the properties back. You want the loans to perform and pay off, at maturity or before. What do you think, just put you on the spot a little bit, but as far as the exit strategies go, how, roughly, I know you probably don't have this on your fingertips, but how many of those payoffs occur because the asset is sold versus how many go out and get more conventional type financing to pay off the loan?
Yeah, the majority are able to exit through conventional financing. Some of our borrowers, their strategy when they come to us is a sale. A lot. It's interesting, but if a property is listed for sale, it's no longer financeable. A bank, when they need to have it on their books for a considerable amount of time, they're not charging the premiums that we are. So if you pay off early, they never got a chance to make any money on that. So a lot of times a conventional loan may have a prepayment penalty that could be very onerous in the first 5 years of a loan. Sometimes a borrower, if they have a loan ballooning and they haven't got it sold yet, it's listed for sale, they're no longer financeable. So their whole exit strategy is just a sell. But I'd say majority are ending up with conventional financing, and some that the whole plan was, again, was to liquidate the property, sell it.
Okay. Yeah. So this slide that's up here, I mean, you feel this is a pretty good representation of some of the types of assets that you're loaning against. You can see the loan to values there, I guess, range from 39 up to 65%, as you mentioned, generally short-term loans, 6 months up to 3 years. I also notice that you're tying the interest rates after it looks like you fixed them for some time period, and then they are adjustable rates after a period tied to SOFR. Is that, maybe talk us through some of the terms and this slide in particular?
Yeah, I mean, I think most projections we're at the end of the rate hike period, but we want to make sure that the portfolio was flexible and we didn't have interest rate risk into that. So from a borrower's perspective, we fixed the rate for the first 6 months. So that takes away some of the worry of from the borrower's perspective. But globally for our portfolio, after 6 months, the loans all adjust. So if the Fed increases rates unexpectedly at this point, or expectedly for the last 2 years, the portfolio, and I think we have a slide there that kind of does show you what the average note rate has been. So you see that inching upward year over year, and it continues to move forward as loans adjust and higher rate loans are coming into the portfolio and lower rate loans are falling off. Since the REIT came into existence, we've closed 84 loans to date, and within the next couple of weeks, we'll tip over $300 million worth of loans funded.
Wow, that's great. And I think there's another slide, but let's stick to this one for a second. I was going to say there's another slide that kind of shows some of the track record on the portfolio, and we'll get into kind of how that portfolio is performing here in a second. But so you're paying out a...
Yeah, I was going to say, if you look at this slide, for example, the 8.89, 9.18, 10.72, the return at the end of the first quarter was just a tick over 12%. So you can just kind of see the steady rise corresponding to interest rates rising. So, we've done a good job here of hedging our investors' interest rate risk as things adjusted upward.
Yeah, and then so you're making a 8% preferred return being distributed monthly to investors, and then maybe talk us through, like, let's say your average note rate is 12%. How does that flow down to investors? Maybe regarding the structure of the fund.
Sure. Yeah. So I'd say the majority of our investors are either at, or most of them are in retirement. So they're looking to supplement their cash flow. So we've set up a 8% since the fund's inception. We've distributed monthly. So you take your investment amount times 8%, divide that by 12. That is the monthly distribution. Avatar also charges a 1% servicing fee. So together that gets us to 9%. If you said instead of Q1, if that was a year end and we were at 12%, that would then leave 3% above the preferred return of 8, the 1% servicing fee. That is then split 50-50 between the investors and Avatar.
Perfect.
So that,
okay.
The distribution's made, and we do have a chart there that kind of talks about most of our investors are able to take advantage of a tax deduction that was set up in the Jobs Act. So
yes.
So
yeah, talk us through that. That was going to be one of my questions. So talk us through kind of the tax structure of how this works for investors.
Sure. So the reason we set up the REIT, having, instead of just an LLC for people to invest in, the REIT structure currently allows 20% of the dividends to flow through to, everybody's got to talk to their own accountant, but to vast majority of our investors tax-free. So what this chart here illustrates is the tax savings adds about a 1% net to your actual in your pocket post-tax return. So it is a tax efficient structure. So provides diversification in property type, geography, and then has a tax advantage to it.
Perfect. Okay. Anything else to cover here? Otherwise, we can maybe
one thing we didn't touch on is after 1 year, there is the ability to redeem your investment. So obviously there's a caveat there. If something drastic were to happen, management would have the right to distribute based on everyone's percentage. But as long as we're in a normal environment, people can redeem after this. So there's basically a 1 year lockout.
A 1 year lockup, then investors can put in that redemption request, and as long as the fund has the ability or the management desires to do so, you'll honor those redemptions.
Correct. And one other slide to maybe touch on there is the one that's kind of the inverted triangle there. Just when you're looking at different investment opportunities, if you're in a period of your life where you're willing to take more risk and the higher reward is worth it, and if things all go to hell, you can start over. Common equity, there are REITs that own real estate, and so on those, you're the equity, and then they're borrowing most likely from banks, but there's a bank that is the debt. So if things turn down, the bank pushes out your equity, they end up owning the property. We're the inverse of that. So our borrowers are putting in their cash equity, expecting to receive a higher return on that. But at the end of the day, we're that first lien debt. So if the economy turns, the equity gets extinguished, and we end up at least owning those properties.
Yeah. And so I'll help put a little bit finer point on that. I mean, senior debt or senior first position debt is going to be the safest position of the capital stack to be in, which is where you're at. The other benefit often in your case of these lending funds and being in that senior position is that you have real-time income from the interest payments coming off of that you can then distribute to investors also in real time, in your case monthly. As opposed to the common equity, the bottom of this triangle, where you're taking the highest risk in the capital stack, and oftentimes the returns off of that equity is generally through the value that's created and the eventual sale, and sometimes those can produce cash flows along the way, but usually that's a lot harder to predict. They're lumpier cash flows, and you're really, again, at the higher risk depending on how the market moves. So the return profiles of that equity can look higher, right, for that reason of the higher risk. But in your case, I think lower risk and the distributions are really the key features there.
Correct. And both of those investments, again, just depending on where you're at in your life, could be, one may be favorable to the other. It just, again, it depends on each person knows where they're at. Are they trying to limit risk at this point and preserve capital and receive a reasonable return and protect their nest egg? Are they trying to really aggressively grow so later in life they'll have that nest egg?
Yeah. And the industry terms, I suppose, that are more common with stocks and bonds would be, growth versus income. And you're really an income type of a play here.
Correct.
Yeah. Great. So let's get into a few questions, because I know we're kind of starting to get down to some time. But one of the questions that an investor asked me about Avatar a day or two ago was in regard to your current portfolio and the performance. I mean, are you guys having any challenges? You mentioned office has a bad name right now, probably rightfully so, but and just commercial real estate in general has some challenges out there. But talk us through the performance of your portfolio. I mean, are there challenges going on, any more than normal, or however you want to answer that question?
Yeah. So, I mean, historically, I think that's on here too. Our REO rate, REO meaning where we've actually completed a foreclosure, has been sub 5%, somewhere in the 3% range. We did have one foreclosure that took place in January. It was a $2.3 million loan on an industrial building. We sold the property to the tenant in February for $3,850,000. So, pretty fantastic, return on that REO. In defaults are something that is always a portion of your portfolio. Typically, the vast majority of those will not end up in a actual foreclosure. With the portfolio being in the mid 50% LTV range, that's also kind of part of our underwriting. is making sure there's always a hard money lender there, that if we get into default, there's enough meat on the bone, there's enough LTV that they'll come
Yeah.
in and take us out. So for the most case, when we have a default, they do cure before we end up actually owning the property. And I would also say that that one foreclosure that we had is very unusual to have that kind of a return. That was that was
Sure.
pretty spectacular. So I would not set any expectations that that's the normal. Historically, we've been closer to about a 7% positive return on properties we've owned. So that's an outlier. It just happens to have just happened. So.
And when that does happen, are those returns then put through the fund and the normal waterfall?
Correct. Yes.
Yeah. Okay. Great. Let's see. A few other questions here. So,
Darius, wait, from the audience, a couple questions about underwriting. Can you share how often your fund has achieved or exceeded its underwriting projections for investments? And the other one is just what's their process?
Sure. So we have, well, obviously my partner and I have been at this since 1995. I don't think we have here a list of who our underwriters are, but if you go to our website, Mark Holman, who's our lead underwriter, he spent 25 years at Goldman Sachs prior to joining us. So a real breadth of experience. If you go on the website, also Jeff, who's one of our other underwriters, also has been in the industry for 25 years. And we have a third underwriter who also had 25 years plus in the industry. So we have a very seasoned team underwriting. We have one person in California, one in Texas, and one in Boston, so Massachusetts. So we kind of have the country covered relatively well. In general, it was going to be interesting as interest rates went up, cap rates compressed. That's when the tide goes out, you find out who's wearing shorts. Our portfolio has held extremely well, where the returns are in excess of, I think, what we expected. The return in the first quarter was above the average note rate, and that's because for one REO sale definitely helped, but then also loans that had gone into default, refinancing out or being sold with the default rates approximately 10% above the note rate. So the portfolio has performed very well.
that's great. So one final question that came in: what do you expect to happen to the fund returns as interest rates eventually come down, as most people predict they will over time? So maybe just talk us through that, and I suppose how that relates to the preferred return and that sort of thing.
Sure. Yeah. I mean, right now, I think we are in a very unusual situation where the supply of bank debt has all but evaporated or severely pulled back. My competition has also, a lot of them are sidelined. So I think rates right now are about, for the next 12 to 24 months, are about as high as you are going to see. And then I think things will start coming back down. I don't think we're going to get back to a level of cheap debt that we were for the last maybe 5 years before this increase. So I think we're going to reset somewhere higher. So I think if you look at our historic returns of paying out an 8% dividend, we're significantly in the money now in having the first quarter a 3-point spread to split between the investors. So I think that is going to retreat. I don't think it will reset as low as before, but yes, it is going to pull back as rates start to drop.
Yeah, I agree with all that. And I mean, with the long track record that you guys have, you've been through these sort of cycles and rate adjustments, quite a long time. So I'm sure you thought that all through. And
Sure. Well, and,
know how
and
to
also
navigate.
as an investor, when you're looking at alternative investments, if you're looking at, a ultra safe, a bank CD, as rates drop, those drop correspondingly. So I think you're
Yep.
going to see, right now as an investor, if you are liquid, there's not been a better time to achieve pretty significant returns, and high returns. Even if you drop in a bank CD, you're getting
Right.
a huge multiple to what was possible 3 years ago.
Right.
One last audience question. How do you keep investors up to date about your portfolio?
Yeah, the investors receive a monthly statement from Avatar, but then every quarter we send out a newsletter to our investor group, kind of a management recap, both globally, kind of what do we see in our industry, what have we seen in the last quarter, what do we see coming forward. And then we also have a link there where the investors can click through, and it's a property by property portfolio report. So you'll be able to see each loan in the portfolio and how it's performing, what the average note rate is. But then you can dive into and see how each asset's performing, what the paid to date is on each loan in the portfolio. So we try to give as much transparency as we can. There's also a graph like you saw there, so you can kind of keep up to date on what our product types are, what our geographic diversity looks like.
Yeah, perfect. That's a good segue, I think, to wrapping up here. So a lot of that information that you just talked through, the portfolio report with the links, the graphs, we have in a due diligence room that can be made available to investors upon request. The team at FundSomm is available to chat and talk through this offering or any others that are on the website, as well as, TR can make himself available to any investors that want to dive deeper into Avatar and this particular offering. And that whole investment process can take place through the FundSomm marketplace. So all the way from reviewing materials to filling out the subdocs, and the wiring of money instructions and whatnot. So myself and my team happy to answer any questions that investors have as follow-up. And I don't know, TR, anything you want to add before we wrap here?
No, appreciate the time. Also, probably important for all the investors, we do have a third-party administrator, Veravest. We have a Cohn-Resnick as our auditor. So our audit was already distributed to and available to all of our investors. And then Veravest is the fund administrator.
Yeah, I appreciate that's a good comment there. So this is a big part of what we're trying to do at FundSomm, is just bring on managers with a high level of experience that kind of check a lot of the boxes, which you just touched on: the audits, the administration, track record, background checks, all that sort of thing. So that's great. So TR, thank you so much for joining us today. I thought that was a really thorough overview of the fund, and look forward to continuing to work with you and the team at Avatar.
Thank you for your time.
Thanks.
All right. Thanks.